All right, you guys, so we're going to pick up where we left off from part one. So we talked about these two very specific official definitions of poverty that we use in the United States. In the United States, we define poverty as living below the federal poverty threshold or the poverty line. So we talked about that, and then also the threshold is used to establish a second definition of poverty, which is the poverty guideline. This is the actual guideline or number that we use to establish eligibility for social programs. A note that I did put on here, kind of the comparison of those two measures in 2018, $25,283 is the poverty line for a family of four. In this same year, the poverty guideline for that same family would be $25,100. So these are not far off. They're really minute differences on average. So if you slip up and you use one in place of the other, it's not a huge deal. However, if you are dealing with program eligibility, it's really important that you're using that guideline. But if you're just citing some statistic and you get the wrong one, it's not the end of the world. Okay. I noted the difference by geography. Hawaii and Alaska just have very specific contexts because of their economies, right? Both of them are a little bit remote, which means that the prices for goods and services in those states are very different. They also have high poverty rates, and so they have their own poverty guideline separate from the one used here in the continental United States. The other thing I want to note about this definition is that it is a hard line. So if you are in a family of four and you make $25,282.99, you are considered poor. If you make $25,283.01, you are not considered below the poverty line. So it is a hard line. There's no fuzziness in there, right? And of course, that's one of the criticisms of the way that we measure poverty in the United States for official purposes, and we'll talk about some more of those criticisms as we move forward. This is just the poverty threshold table. I already wrote on it. I should have waited until I switched over to this slide, but if you have two related children in that household of four and two parents, right? So we kind of think of the traditional nuclear American family. The poverty guideline, or poverty threshold rather, the line would actually be $24,858 rather than the $283 that I quoted earlier. That's going to be your most common situation for a family of four. But of course, you can see the other poverty lines for other family situations. Note again that the poverty line does account for the age of individuals in the household and the number of people. And it also accounts for age, not just on the child side, but on the adult side too. These are the poverty guidelines for 2018. Notice again, it doesn't account for age. So this is how it differs. It doesn't account for age, but it does account for family size. And up here, you'll see this row of percentages, right? If you are living at 100% of the poverty line, that means you are right at the line, right? You are 100% of the poverty line is the poverty line, okay? You may be in the bottom half of the poor. If so, right, you're going to be at 50% of the poverty line or below. Okay, so you can see what the poverty guideline is in that case. Okay. However, in order to deal with that hard cut point that I just talked about, the fact that if you're even just 1 cent over or 1 cent under, it could put you in a different status. Some programs set their eligibility guidelines at a certain percentage above the poverty line, right? So in some states, you are eligible for Medicaid, or to be eligible for Medicaid, you don't have to be under this actual poverty line, right? You can be at 138% of the poverty line. So you're making over what is considered the poverty line, but you're not that far out away, right? And this is to deal with that kind of questionable hard cut point, right? So to allow for some grace room in income in order to determine program eligibility. And 150%, and it goes on and on and on. Although most program eligibility is in this range, anywhere from you have to be right at the poverty line or under, or you have to be between 1 and 150%, 150% of the poverty line to be eligible for a particular program. Just so you can see the difference in the poverty guidelines for the continental United States and Alaska and Hawaii, I just noted up here for Alaska in 2018, 100% of the poverty line is $31,380, so substantially higher for a family of 4. In Hawaii, it's a little bit higher, $28,870, and again, that's due to the specific kind of regional nature of those states. So how do we get this number, right? Somebody has to figure out a formula to determine what is the line. So what is the number below which you're poor and above which you're not poor? We measure poverty the same way that we measured it in 1964. In 1964, an economist for the Department of Agriculture named Molly Orshansky was asked to develop a measure of poverty. And at the time, the average American family spent about 1/3 of their total income for food. And so Molly Orshansky said, well, if that's right, then if you multiply that, the cost of food, essentially, at any given time, by 3, you should get the income at which individuals can survive above the poverty line, right? So anything below that would be in poverty. And so that's where we are. Well, then you have to think, well, what is average income and what do people spend their money on? So what counts as income in the poverty measure? Your earnings, of course, what you're making at work, pre-tax though, right? So before any taxes are taken out, your gross earnings. Any money you get from Social Security, disability, or unemployment, obviously counts as income. That's your social insurance benefits. Any money you get from public assistance, cash money from public assistance, would count as income. Your pension or retirement income, including Social Security, but also private pension or retirement. Interest and dividends on investments, royalties, rents, and trusts. Any educational assistance you get. So your student loan counts as income. Any education tax credits would count there as well, counts as income. And then any alimony and child support income that you might be receiving would count as your income. And the poverty measure is increased every year for inflation because the way that we price out goods is by the Consumer Price Index. And of course, that basket of goods takes into account inflation as well. Now, you may be sitting here thinking, something about this measure is not right. And if we were in class, this would be the point where I would say, what is not right about this measure? The most obvious thing is that Americans don't, today, in 2018, don't spend anywhere near 1/3 of their income for food. Food is much cheaper today than it was in 1964, and other goods are much more expensive. The average American family spends less than 1/5 and almost less than 1/6 of their income for food. The things that have gotten a lot more expensive are transportation, education, and housing. And so people are spending a lot more money on those things, but the poverty measure has not been adjusted to account for the realities of what we spend our money on in the United States. So that's the most prominent criticism. There are other criticisms, though. One is that the poverty index or the poverty calculation doesn't include any cost of employment, right? So the child care that you have to procure so that you can go to work if your children are under school age, younger than school age. Transportation costs to get to work. Professional supplies, including the type of clothing, uniforms you might have to buy, materials or supplies that you have to buy for your job. It doesn't take into account regional variations in living costs. So this poverty rate applies the same for urban poverty in California as it does to rural poverty in Mississippi, right? And living costs are very different in those places. It doesn't take into account that you lose income paying sales tax, payroll, and property taxes, right? Because it's a pre-tax measure. It doesn't account for the value of or the cost of healthcare coverage or out-of-pocket medical expenses. And of course, that has gotten significantly more expensive since 1964. This measure doesn't account for lifespan needs. So it doesn't differentiate costs associated with having children at various ages or caring for elderly parents in your household, right? It doesn't account for the gig economy or the casualization of the workforce, right? So this measure is not built for your Uber driver. It's not built for the person that rents out their home for Airbnb. And of course, the main criticism, which I already mentioned on the last slide, or no, on this slide, is that it's arbitrary, right? I mean, it's a hard line, and you know, being just 1 cent over or under puts you in a different status, and that can be problematic. So, in order to address some of these criticisms, the Census Bureau started developing an alternative measure of poverty. They really started working on this during the 1990s, but it wasn't officially put to use until 2010. That's because there were some stops and starts in working on it, and then this kind of measure takes a long time to develop because you've got to develop it, you've got to deploy it, and then you have to test it. You clean the data, you code the data, you make sure it's reliable. And the Census Bureau in particular does not want to put out data that's not good, right? So it took a long time, but the supplementary poverty measure was first used in 2010. The SPM defines poverty as the lack of economic resources for consumption of basic needs such as food, housing, clothing, and utilities. So note it's not just the lack of those things, but the lack of resources for consumption of those needs. So the way that they calculate it, I put the formula here. So family resources is the stand-in for income, right? So the first part of this formula is what you would see in the traditional poverty measure. It takes your gross money income, so that's still pre-tax, any SNAP benefits that you're receiving, housing subsidies, and income tax credits, and that's considered your income piece, right? But then it says, look, some of that income we already know you're spending right off the top, and it subtracts those things. So it says we know you're spending medical out-of-pocket expenses right off the top. We know that you're paying payroll taxes, so your FICA taxes, so we subtract that. We subtract child support payments because we know that money is probably getting eaten right up by providing for your kids. It subtracts work-related expenses, including transportation, and it subtracts childcare costs. So all of those kind of criticisms of what the poverty measure didn't address, the supplemental poverty measure does account for. And then it spits out a different number as to what the poverty line should be. A couple of things to note on the supplemental poverty measure. Of course, as you might imagine, it's a little bit lower, so more people fall under the poverty line with the SPM than the actual poverty line and poverty guideline. This is politically controversial, right? Because depending on whether you think we have more or fewer poor people, you would make policy adjustments to handle that. The other thing is that currently it is only used for census and information purposes. It is not used to determine eligibility guidelines, right? So it's really just for information and to be able to have some of these debates about how we should measure poverty and what those measures might look like. So in the next part of the lecture, we're going to actually look at, based on these measures, who is poor in America, okay? And what that looks like across different categories. So we'll pick up there in part 2.